Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 440 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today we are going to be talking about mortgages, and specifically the adjustable rate mortgage, because I want you guys to understand what these are and why I don't necessarily think that they are a great idea for you, for myself, for the vast majority of people. I want to break down the differences between those and the fixed rate mortgage, and then just talk about why right now it may be enticing to get an adjustable rate mortgage, but why it may not be the best idea. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental material to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, I really want to start this episode somewhere that you may be familiar, right? And that somewhere that you may be familiar is the fixed rate mortgage. And the fixed rate mortgage is nothing crazy, right? It's really straightforward, makes a lot of sense, just the normal loan, right? But let's talk about what a fixed rate mortgage is, right? What a fixed rate mortgage is, it's a loan on a home, right? That charges a set rate of interest that remains unchanged throughout the life of the loan. Now, that does not mean that the amount of interest you pay every single month is the same. It means the percentage of interest that you pay every month is the same. Okay, so this can be best explained through what's called an amortization schedule. And if you have a mortgage, I guarantee you can go to your mortgage website and you can pull up your own amortization schedule of your mortgage, right? They make them for you. Now, what the amortization table tells you is it tells you what your beginning balance of your loan is. It tells you what your payment is. It tells you how much of that payment is a principal payment and how much of it is an interest payment. Okay, so just for simplicity, let's say you have a $100,000 loan over 30 years at 6%. Okay, it's just for easy numbers. I know this isn't super realistic, but the numbers work out. Okay, so that means the first month you're going to pay 0.5% in interest because it's 6% annually. So you divide that out by 12 months. So that's half a percent per month. Okay. So you're paying 0.5% on 100,000. So you know the interest portion of your payment is going to be $500. Then you calculate your payment based on the loan itself, and your payment's $599.55. Your payment will always be $599.55 over the life of this fixed rate loan. Okay. But the interest portion and the principal portion will change based on the current balance, the starting balance every single month, right? So for instance, that first month, your interest is $500 because it is 0.5% of the $100,000. And so your principal portion is $99.55. So you only pay off $99.55 of the loan, even though you made a $599.55 payment, right? Because $500 of that was interest. Now, the next month, you again make a $599.55 payment, right? But now the principal balance that you're paying on is not $100,000 anymore. It is $99,900.45. So now you pay 0.5% of that in interest. So now your interest portion is $499.50 and the principal portion is $100.05. Right? So you see your interest portion of the payment goes down, the principal portion of your payment goes up, and that will continue over the life of your loan, even though your payment stays the exact same for every month for, in this case, a 30-year loan, right? So the main advantage of this fixed rate loan is that the borrower is protected from sudden and potentially significant increases in the monthly mortgage payments if interest rates rise. Fixed rate mortgages are easy to understand and vary little from lender to lender. The downside is that when interest rates are high, qualifying for a loan is more difficult because the payments are less affordable, right? Because obviously higher rates are going to lead to higher monthly costs for your loan. Now, although the rate of interest is fixed, the total amount of interest you'll pay depends on the mortgage term. Traditional lending institutions offer fixed rate mortgages for a variety of terms, 15, 20, 30 years are some examples. So I'll give you an example of this, right, of how much interest you can pay over the life of a loan. So if, let's say, you were making payments on, let's say, a $300,000 house, right? Let's say you had a 4% loan on a 30-year mortgage. Okay, and I said that was 300,000. Then you would be making a monthly payment of $1,432.25. So if you took that and you multiplied that out by 30 years, 12 months a year, that's $515,608.52. Okay, so that's the total amount of payments you made, but it was only a $300,000 mortgage. Right, so you paid $215,608.52 in interest. Quite substantial, right? Well, let's say the exact same house, and for the example's sake, let's say that the 15-year mortgage had a 3% rate instead of a 4%, right? So it's automatically going to make it less interest over time, but also it's a 15-year mortgage, okay? So a 15-year mortgage, your payment would increase to $2,071.74 a month. And you would make total payments over the life of the loan that equaled to $372,914.09, right? So that means you only paid $72,914.09 in interest, right? So you just compare those two loans, right? By picking the 15 over the 30, you save yourself $142,694.43 in interest. So that's the benefit of paying a mortgage off early or having a shorter mortgage. It's the amount of interest you'll pay over time. Now, the 30-year mortgage is the most popular because it offers the lowest monthly payment. However, the trade-off is that you will have a significantly higher overall cost because the extra decade or more in the term is devoted primarily to paying interest, not just paying down the principal in a faster way. So that's the fixed rate mortgage. Most of us know what that is, right? But that is not everything, right? That is not what I wanted to spend the vast majority of my time on today. I want to spend time on the adjustable rate mortgage, right? Or otherwise known as the ARM, right? ARM, adjustable rate mortgage. So the interest rate for an adjustable rate mortgage is a variable interest rate. It is not fixed, okay? The interest rate on an ARM is set below the market rate on a comparable fixed rate loan. So automatically that sounds like a good thing, but hold on, right? And then the rate rises as time goes on. So if the ARM is held long enough, the interest rate will surpass the going rate for the fixed rate loans. So ARMs have a fixed period of time during which the initial interest rate remains constant, after which the interest rate adjusts at a prearranged frequency. The fixed rate period can vary significantly, anywhere from 1 month to 10 years. Shorter adjustment periods generally carry lower initial interest rates. After the initial term, the loan resets, meaning that there's a new interest rate based on the current market rates. This is then the rate until the next reset, which may be the following year, right? So basically you have this beginner rate, this teaser rate, or this rate that you're going to be able to keep for some fixed amount of time. But then there's this reset to this new rate, whatever the new interest rate is. Now, this can be valuable if interest rates were already very high and you know interest rates went down over the life of your loan, then you could be paying a lower rate when it adjusts downward. But let's say you're in the environment like we're in right now, where rates are going to rise, right, are currently rising, then, if you have an ARM currently, then you're probably going to pay more once your loan resets if it's in a reasonable amount of time, right? So that can be something that hurts you and obviously makes you pay more on your mortgage. Now, ARMs are significantly more complicated than fixed rate loans, so exploring the pros and cons requires an understanding of some basic terminology, right? So we need to know there are adjustment frequencies, right? So this is the amount of time between interest rates adjustments, right? So it may be monthly, yearly, whatever. There are adjustment indexes, right? So there's some benchmark that the rate is tied to, often like LIBOR or something like that. Then there's margin. So when you sign your loan, you agree to pay a rate that is a certain percentage higher than the adjustment rate. So for example, your adjustment rate, may be the rate of the 1-year treasury bill plus 2%. The extra 2% is what you would call margin. Then there are caps. So this is the limit on the amount of interest rate can increase each adjustment period. So some ARMs also offer caps on the total monthly payment. So these loans, also known as negative amortization loans, keep payments low. However, these payments may offer only a portion of the interest due. Unpaid interest becomes part of the principal. And after years of paying the mortgage, your principal owed may be greater than the amount you initially borrowed. So that can be problematic. And then there's also ceilings. So this is the highest that the adjustable rate is permitted to reach during the life of the loan, right? So you would want a low ceiling, assuming that you take out one of these loans. Now, the biggest advantage is that it's considerably cheaper than a fixed rate mortgage, at least for the first 3, 5, 7 years, right? Because they give you low initial payments and enable you to qualify for a larger loan. And in a falling interest rate environment, it can also allow you to pay less later on and not need to refinance the mortgage. Now, a borrower who chooses an ARM may have several $100s a month for up to 7 years, after which their costs are likely to rise. The new rate will be based on market rates, not the initial below market rate. So if you're very lucky, it may be lower depending on the market rates, what they are at the time of the rate reset. The ARM, however, can pose some significant downsides. With an ARM, your monthly payment may change frequently over the life of the loan. And if you take on a large loan, you may be in trouble when the interest rates rise, meaning you can't pay your mortgage, which is a big, big problem, right? Some ARMs are structured so that interest rates can nearly double in just a few years, right? And just to see what the impact of a doubled interest rate would look like, let's go back to our example where you're paying $1,432.25 a month on a 30-year mortgage, right? And let's say instead of a 4% rate, the loan jumps to an 8% rate, right? That takes your payment up from $1,432.25 to $2,201.29, right? So that means your house payment increased by $769.05 based on a doubled interest rate, which is huge, right? So you can see the type of impact that something like that can have. Now, indeed, adjustable rate mortgages went out of favor with many financial planners after the subprime mortgage meltdown, right? Because that was a big thing that was being used back then, right? These teaser rates, hey, we'll get you in at this fixed lower rate and then they'll adjust later, but then you can refinance later, be all good, and then it didn't work out, right? Tons of foreclosures, short sales, all things like that made it far less palatable to the people who were once selling them quite a bit. Now, borrowers face sticker shock when their ARMs adjusted and their payments skyrocketed. Fortunately, since then, government regulations and legislation have been instituted to increase the oversight that transformed a housing bubble into a global financial crisis. The Consumer Financial Protection Bureau has been preventing predatory mortgage practices that hurt the consumers. Lenders are lending to borrowers who are more likely to repay their loans than they used to be. So those are the big differences, right, between that fixed rate and the ARM, the adjustable rate mortgage. Now, why does this matter? What does this mean? What does this mean for us, right? So ultimately, we know that interest rates are going up, right? And when interest rates are really, really low and had been really, really low, what is attractive is taking out a fixed rate mortgage, right? Because if you can get the lowest rate possible and you can lock it in for 15 years or 30 years or however long your mortgage is, then awesome, right? You can lock in a low rate. You can pay very little in interest. That's fantastic, right? But when rates are rising, people are looking for any way that they can to decrease their costs, right? To decrease what they are going to ultimately have to pay. And one place that you can look is the ARM. Now, I want to caveat all this by saying I saw something recently that was like an ad for like mortgage rates back in, I think it was like the 80s or something like that. And it was like low rates, and the rates were like 9, 10, 11% on mortgages. So I think everything, I just want to preface all this. Everything is relative, right? Everything is relative based on what you're used to when you live and what the financial situation looks like in the economy. But nonetheless, right, we are in the middle right now, or at the beginning of a rising rate environment, right, where the Fed has said we are going to raise interest rates, and mortgage rates have, jumped accordingly, right? Now, what this means is that people are going to look for ways to decrease their costs if they're going to take out a new mortgage, right? So people may look to the ARM, right? So you have the lower initial interest rate compared to the 30-year fixed. However, that rate can change down the road, and it may not change in your favor. Right, so there's a lot of variability in the specific terms as to how much the rates can go up and how quickly. No one can predict what rates will do, but one thing is clear, there's a whole lot more room on the upside than there is on the downside. And I think that's the scary thing, specifically about the ARM. I know there may be ceilings or caps to an ARM mortgage, but ultimately, there is a lot of upside room for interest rates right now. There's a lot of upside for interest rates to just run, and obviously the fight against inflation is a big one. So if interest rates can go up very, very high, then you need to be able to know that you can make the payment if needed, right? So this is a planning conundrum, right? Short-term decrease in costs for this long-term potential spike in our costs, right? So what do you want? What is more beneficial to you? Now, interest rates remain low from a historical perspective, right? So even where we're at right now, historically, interest rates are still very low. The median list price of a home in the U.S. is $405,000, up 14% from a year ago, according to Realtor.com. The average fixed rate on a 30-year mortgage is 4.67%. Now, this is the big kicker, right? The big kicker is this is up from below 3% in November, right? So from just November to now, the rates have increased substantially. I mean, the rates today on a 30-year fixed are comparable to what they were in January of 2019, right? So, I mean, this is over 3 years ago since we've seen something like this. Now, according to the Federal Reserve Bank of St. Louis, they have not been this high since 2018. Now, by comparison, the average introductory rate on one popular ARM is 3.5%. So you compare 4.67 to 3.5. If that was all the math you were doing, and you're like, oh, well, that's cool. So let's go back to our example. Right? Let's go back to our example of a $300,000 mortgage, right? You have a $300,000 mortgage, and let's say it's at a 4.67, right? That's $1,550.51 payment on principal and interest. Well, let's compare that to 3.5% on the ARM. The initial rate on 3.5%, that would make your payment $1,347.13. So you would save over $200 a month in your payment by taking that initial ARM rate, which sounds great, right? And it can be that way for the 5 years or whatever the fixed amount of time is. Now, after that, the rate could go up or down or remain unchanged, right? So that uncertainty makes the ARM a riskier proposition than the fixed rate mortgage. And let me just tell you this. I don't know about you. I don't really love the idea of my home being a risky proposition, right? I think fixed rate mortgages, at least still today, should be what's used. But we're going to continue this conversation and talk about it a little further, a little more complete. Now, this holds true whether you are using an ARM to purchase a home or to refinance a loan on a home you already own. If you're exploring an ARM, there are a few things to know. For starter, obviously consider the name of the ARM. There are 5-to-1 ARMs, which means that the introductory rate lasts 5 years, and then after that, the rate can change once a year. So 5-1, right? And then some lenders offer ARMs that are like 3 years, 7 years, 10 years with 1 year adjustments. And then aside from knowing when the interest rate could begin to change and how often, you need to know how much that adjustment could be and what the maximum rate charged could be. So don't just think in terms of a 1% or 2% increase, right? Could you cope with the maximum increase in the rate? And if you can't, then you do not need to take out this type of mortgage. I don't think you should take out this type of mortgage anyway, but if you did, then you need to make sure you could deal with the maximum increase on one of these. Now, mortgage lenders employ an index and add an agreed upon percentage point called margin to arrive at the total rate you pay. Commonly used benchmarks include the 1-year LIBOR, which stands for London Interbank Offered Rate, or the weekly yield on the 1-year Treasury bill. So if the index used by the lender is at 1% and your margin is 2.75%, you'll pay 3.75%. After 5 years, if the index is, let's say, at 2, your total would be 4.75%. But if the index is, say, at 5, right, then what, right? If the index is at 5, then you're at 7.75%, and that is a drastic change in payment from where you started, right? So let's just do that math. If you take 3.75, right, beginner rate, and let's say then you're at 7.75, that's an increase in payment of $759.89 on a $300,000 home. So that's huge, right? Now, an ARM generally comes with caps on the annual adjustment and over the life of the loan. However, they can vary among lenders, which makes it important to fully understand the terms of your loan. So there can be an initial adjustment cap. This says how much the interest rate can increase the first time it adjusts after the fixed rate period expires. It's common for this cap to be 2%, meaning that at the first rate change, the new rate can't be more than 2 percentage points higher than the initial rate during the fixed rate period. Then there's a subsequent adjustment cap. So this clause shows how much the interest rate can increase in the adjustment periods that follow. So this number is also commonly 2%, meaning that the new rate can't be more than 2 percentage points higher than the previous rate, not just the fixed rate. Then there's a lifetime adjustment cap. So this term means how much the interest rate can increase in total over the life of the loan. So the cap is often 5%, meaning that the rate can never be 5 percentage points higher than the initial rate. However, some lenders may have a higher cap. So right now, if you're looking at that 5-to-1 ARM with a 3.5% rate on it, if there's a 5% lifetime adjustment cap, we're talking the potential for an 8.5% mortgage, which is just, that's huge. That's a huge rate to be paying regardless, right? Now, an ARM may make sense for buyers who anticipate moving before the initial rate period expires. That's a little trick there, right? If you know that it's going to be not permanent, you living wherever you are, and an ARM may make sense for some fixed amount of time to pay less. However, because life happens and it's impossible to predict future economic conditions, it's wise to consider the possibility that you won't be able to move or sell, right? So like I said, if there's any chance that you get the maximum adjustment, right, the maximum increase in your ARM rate, then you need to make sure that you can pay whatever the maximum is. And if you can't, then you do not need to have an ARM. Now, even if you can, that still doesn't mean that an ARM is a good idea, okay? So I'd also be concerned if you do an ARM with a low down payment. If the market corrects for whatever reason and home values drop, you could be underwater on the house and unable to get out of the ARM. ARMs tend to make the most sense for more expensive homes because the amount saved with the initial rate can be thousands of dollars a year. The difference between 3.5% and 5% can be $400 a month. On a 7-to-1 ARM, that could mean saving $5,000 a year or $35,000 altogether. So there may be logic in that. So for a mortgage under about $200,000, the savings are less and may not be worth choosing an ARM over a fixed rate. I don't think it's worth the risk to save $100 or so a month. Now, here's a thought, and I don't want to talk you into a bad financial situation, but this may be an argument that you hear, and it may be something that actually could make some sense over time. I don't know. Maybe it could make some sense potentially. Okay. But let's say that you're somebody who wants to pay your home off early, right? And let's say you can get that 7-to-1 ARM, right? Let's say you save $35,000 over the life of that 7-to-1 arm, right? If in fact you're saving that $5,000 a year, right? And you're at minimum putting that $5,000 a year aside in a savings account, which this is the problem. Most people aren't doing this, right? But just hear me out. If you're putting that in a savings account or invest it over that 7 years, right? And you have at least $35,000, now you can supplement your new payments with that $35,000, right? That savings. Now, here's the thing too. If you're paying off your mortgage early, you probably don't have any extra savings. You're putting that money on your mortgage anyway. But just a thought, right? You could accelerate your payoff if you actually put that money aside over that period of time. Now, all this brings me back to ultimately say that I do not think an ARM is a good idea for the vast majority of individuals. You are putting your home, the place that you live, at risk based on the fact that you may not be able to pay if rates go higher, right? This is a gamble that honestly I'm not willing to make, right? I'm not willing to make this gamble. Even if I ran the numbers and I was like, well, I could deal with the highest rate, I don't like it, right? There is something about certain parts of your financial life having certainty. And I think the place that you live should have some certainty, okay? Because just think about, even if you do a general, like let's say you rent, right? And you're renting from somewhere and you generally think like, okay, even if they increase rents by 50%, I could still pay the rent. That doesn't mean that you like it when they increase the rents by 50%. You probably end up looking for a new place to live, even if you could make that rent payment. Right? So I think the same thing kind of occurs here. Like we'll go, oh, okay, even if it hits the max, we can still do it. But you're not going to like it and you're going to want to get out of it. And so I just think that these can be dangerous. They're enticing in the short term. And if you're going to pay your house off like super quick, then by all means, you can decrease the amount of interest that you're going to pay. Like let's say, for a fact, I'm going to pay my house off in, less than 10 years, right? Maybe you're getting a new mortgage, right? I know for sure I'm going to pay my house off, let's say in 6 years. I could get like a 10-to-1 ARM, right? Have a lower interest rate and get my house paid off earlier, pay less interest in doing so, right? May not be a horrible idea for that person. But if you're a first-time home buyer, don't have a lot of equity, buying a home that, you can't save a whole lot of money on, with an ARM anyway, and or if the ARM rate goes up substantially, it's going to increase your payment quite a lot. I would absolutely not do it, right? I just don't think the ARM's a good idea. Let's stick to the fixed rate mortgage, 15-year preferably, but if you did a 30-year, whatever, but we just want to get it paid off early. We want it to be out of our hair before retirement. That way we have that extra cash flow in our pocket. So hopefully this helps you to understand a different part of an option that everybody has if you're going to buy a home, and maybe deters you from this enticing financial product that has gotten many a person in trouble in the way that they have to deal with their mortgage payment and potentially be foreclosed upon because they can't make payments based on the fact that they did sign on to a type of mortgage that they did not understand. So maybe this helps you to understand it a little better and make better financial decisions in your future. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. That's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in Monday as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.